US sinks Iranian small boats, shoots down missiles, drones as it opens Strait. The consensus read is already outdated. What matters now is the second-order effect most commentary still ignores. We will map trigger, incentive shift, and downstream impact before the close. On the surface, this is a geopolitical flashpoint. But here's what matters if you work in AI, semiconductors, or tech. The Strait of Hormuz is the choke point for roughly 21% of global oil transit. When tension spikes there, two things happen: oil prices jump, and shipping routes get rerouted, which delays component deliveries by weeks. This is not theoretical. The semiconductor supply chain already runs on razor-thin margins. TSMC ships advanced chips from Taiwan through these waters. NVIDIA's H100 GPUs, the backbone of every major AI training cluster on Earth, depend on stable shipping lanes. Even a 10-day delay in component arrival can cascade into missed training windows, delayed product launches, and billions in opportunity cost across the AI sector. Let's zoom in on what just happened. The US military confirmed it sank Iranian small boats and intercepted air threats in international waters. The stated reason: to ensure freedom of navigation. But this escalation is happening in a moment when global supply chains are already fragile. Post-COVID manufacturing has never fully normalized. China is stockpiling chips ahead of potential sanctions. And now you've got military tension in the world's most critical maritime choke point. Here's the second implication nobody is talking about yet. If this escalates further, if shipping companies start routing around the strait entirely, alternative routes add 10 to 20 extra days to transit time. Container ships can't reroute around Suez and the Cape of Good Hope without burning massive fuel costs. Those costs get passed to buyers. And in AI, where margins on chip sales are already compressed by competition, a 15% freight premium could force smaller AI firms to delay expansion or pivot to less efficient hardware. But there's a contrarian angle worth holding. Geopolitical risk, ironically, accelerates chip onshoring and strategic stockpiling. Companies like Samsung and Intel are already getting government subsidies to build domestic fabs, the CHIPS Act in the US, subsidies in Europe and South Korea. A supply chain shock in the Strait could accelerate the timeline for local chip production, which reduces long-term vulnerability but increases short-term costs. For investors, this means semiconductor equipment makers ASML, Applied Materials, could see more orders for domestic fab build-outs. What changes next? Watch 3 signals over the next week. First, oil prices. If Brent crude spikes above $95, shipping costs will follow. Second, semiconductor stock movements. If chip makers start guiding down on delivery timelines, that signals real supply chain concern. Third, container shipping rates through the Strait. If rates spike while volume drops, that's a sign companies are actively rerouting. And if rerouting happens at scale, expect AI training costs to rise 5 to 12% within the quarter as companies absorb freight premiums. Here's what you should do right now if you're in AI or tech. First, check your supply chain. If you depend on chips, components, or equipment shipped through the Strait, contact your suppliers and ask for updated delivery timelines and contingency plans. Second, if you're an investor in semiconductor or AI companies, monitor earnings calls and guidance for any mention of supply chain headwinds or rerouting costs. Third, if you're building AI infrastructure, this is the moment to audit how much of your cost structure depends on just-in-time component delivery. Stockpiling or securing longer-term contracts now could save you 20 to 30% in freight costs over the next 6 months if this situation stays tense. The broader pattern here is worth understanding. Geopolitical choke points are now part of the tech cost structure in a way they weren't 5 years ago. AI compute is global infrastructure now. And global infrastructure depends on open, stable maritime routes. When those routes get disrupted, the cost flows directly to companies trying to train models, manufacture chips, or scale AI systems. This matters a lot. For the latest on how supply chain shifts impact AI and tech margins, follow Atlas Signal for daily intelligence on markets, strategy, and what changes next. The US just sank Iranian boats and shot down missiles in the Strait of Hormuz. Why does this matter for AI? 21% of global oil transits through that strait. When tension spikes there, shipping routes get rerouted. And a 10-day delay in chip delivery cascades into missed AI training windows, delayed model launches, and billions in lost opportunity cost. TSMC, Nvidia, every major AI company depends on stable transit through those waters.